Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look at, is SHEL PLC stock a buy right now? What is SHEL? Stock ticker SHEL. SHEL engages in oil and natural gas production. The firm is engaged in the exploration, production, refining and marketing of oil and natural gases, and the manufacturing and marketing of chemicals. Its businesses include upstream, integrated gas, renewable and energy solutions, and downstream. SHEL trades worldwide and is a very well-known established brand. Some key parts about SHEL is that it's based in the United Kingdom, is part of the energy sector, has a market cap of over 162 billion. They went public in 2005, have over 80,000 employees, have a 2-year dividend growth streak, have a 3-year dividend growth rate at 21.92% and a fairly nice yield at over 4% as well. We can see that over the last 6 months, SHEL is actually down nearly 12%, and we're going to have a look at today, is it a buy, hold or sell? SHEL's earnings call and fundamental analysis. SHEL continues to demonstrate strong operational performance and significant financial resilience. In their latest earnings call, the company reported adjusted earnings of 6.3 billion and a substantial 13.5 billion in cash flow from operations. These impressive performances is attributed to robust performance across various business segments within the company. SHEL's strong performance has enabled it to continue delivering enhanced shareholder returns. This underscores SHEL's commitment to returning value to shareholders and its financial successes. SHEL remains committed to its principle of performance, discipline and simplification. With a strong balance sheet and a clear focus on capital discipline, the company is well positioned to navigate the ongoing energy transition. SHEL aims to continue driving more value with less emissions, delivering on its financial targets and maintaining a robust investment case for shareholders. Some key fundamental analysis to do with SHEL is that it has a positive free cash flow at 31.1 billion, positive net income at 18.4 billion, positive operating income at 18.4 billion, positive gross profit at 77.3 billion, a positive ROE at 10%. They have very solid long and short-term solvency, a low debt to equity at 0.35, an average Altman Z score at 2.31, average interest coverage at 8.19, and the only negative is they do have positive net debt at 26.5 billion. Moving on, we're going to have a look at SHEL's free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading, as if it was to have a negative free cash flow, this would be ringing some alarm bells. From the graph, you can actually see that SHEL did have a rougher time back in 2016, as they did actually have a negative free cash flow. At the time, this would really put me off buying into the stock, and hence they did have a dividend cut round about that time as well. However, since then, SHEL has gone from strength to strength as the company has announced a new 3.5 billion share back program, and it also marks the 11th consecutive quarter of significant share buybacks, which is a really positive sign when you see this for a company. This only means that their price is likely to drive up in the near future. It has also had 3 years of dividend hikes, and their payout ratio is below 50%, which does show that they have plenty of room to grow. That payout ratio actually being 47%. Next, we're going to have a look at SHEL's discounted cash flow valuation. The DCF is a method that estimates the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. From our scenarios, we can see when plugging in the numbers of a discount rate at 8% and a terminal growth rate of -2%. On the worst case scenario, SHEL will be valued at 2,512 GBX. On the average case scenario, when plugging in a discounted rate at 7.8% and a terminal growth rate at 0%, we can see they will be worth at 5,449 GBX. And on the best case scenario, when plugging in a discounted rate at 7.6% with a terminal growth rate of +1%, we can see SHEL will be worth a massive 18,569 GBX. I not only look at the DCF valuation, but we also look at something called the relative valuation. This is a method used to value a company by comparing it to other competitors based on certain metrics. These metrics include EV to revenue, EV to EBITDA, and PE ratios. You can actually interchange plenty of different metrics for this method, and you can choose which ones that you want to use when valuing a company. When I plugged in my numbers, I can see that SHEL, on the worst case scenario, was worth 8,673 GBX. On the base case scenario, being worth 11,248 GBX. and on the best case scenario being worth over 14,000 GBX, which is an undervaluation of a massive 82% currently. From this, we can actually come up with something called the intrinsic value, and that is by combining the two methods together, dividing by 2 to get the answer. This is something that's been used by many different investors over many years, and is one of the reasons why I like to use this as part of my valuation process. If we remember, Shell's current price is 2,565 GBX, also known as £25.65. Their worst case scenario, they would be worth 5,592 GBX. Average case being worth 8,348 GBX, and the best case being worth 16,308 GBX. I not only look at the intrinsic value, but I have one of the methods that I like to use when valuing a company, and that is the Wall Street estimates. The Wall Street estimates are an average estimation of a public company's quarterly earnings and revenues that lead to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that company and therefore comes with what they believe is an accurate valuation. A company the size of Shell are going to have multiple analysts looking on a daily basis, analysing the company, hence why I really like to use it as part of my valuation method, because I believe they are fairly accurate valuations. On the worst case scenario, they believe that Shell would be worth 2,777 GBX, which would actually be an 8% upside on the current price. On the average case, they believe it would be worth 3,492 GBX, which would be a 36% upside in the current price. And on the best case scenario, they believe it would be worth 7,243 GBX, which would be a massive 183% upside on the current price. From this, we can now have a look at my overall results and come up with my 3 valuations, the best, worst and average case scenarios. On the worst case, when adding my 3 valuations together, we can see Shell will be worth £46.54. So with a 10% margin of safety on the worst case price, you'd be looking to buy at £41.89. And with a 20% margin of safety on the worst case price, you'd be looking to buy at £37.24. On the average case price, Shell will be worth £67.30, meaning with a 10% margin of safety, you'd be looking to buy at £60.57. And with a 20% margin of safety, you'd be looking to buy at £53.84. And on the best case scenario, we can see they would be worth a massive £132.86. So with a 10% margin of safety, you'd be looking to buy at £119.57. And with a 20% margin of safety, you'd be looking to buy at £106.28. So what does this mean for Shell? Well, I believe that Shell right now is at a very attractive price. They have been around for a long time, and although in a very volatile cyclical sector, seem to be going from strength to strength with their robust performance across all sectors. On top of this, as a long-term dividend investor with the attractive dividend yield and promising recent dividend growth, it is a stock that I personally want to have in my portfolio, especially as they have such great free cash flow and are continuing to buy back shares every quarter, which will only likely increase the price over the long term of the share, meaning that I'll not only be receiving some very nice dividend payments from this company, but I'll also hopefully be making some nice capital gains. From my valuations, you can see that on the worst case scenario with a massive 20% margin of safety, Shell is still massively undervalued. And at these prices, I have not been able to ignore this stock. Do you currently own Shell in your portfolio? Or are you looking to add Shell into your portfolio? Or is it potentially just too volatile for you to have in your current portfolio and you prefer to stay away from this sector? Let me know in the comment section down below. I hope you enjoyed today's video. Please let me know of any other stocks you want to see a stock analysis video on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor. Over and out.